So these control activities are important because once we know that something, we're assessing the risk, we have to make sure that the risk of the potential impact is limited. So we have to put the control activities which mitigate those risks. Once we do that, we're going to move to the next one, how we're going to use the information, how we're going to communicate. Information obviously is necessary for the entity to carry out the internal control responsibility. And communication happen both internally and externally to provide the organization with the information needed to carry out day-to-day internal control activities. So what we're going to say probably in our case is we're going to ask every teacher when he start the lecture, start the recording, which recording is safe on the Zoom, which Zoom is owned by the ACCT School of Management. And every week somebody can go there and check the recording. What's the length of the recording? If the length of the recording is 2 hours and 20 minutes, our objective is met. So that will reduce the risk. And we're going to communicate this with everybody. That's a very simple thing that you can do. So the communication enables the personnel to understand the internal control responsibility and the importance of achievement of the objectives. What's the objective here? To provide education which ensure our students that they're competitive, and when they graduate, they can actually find a job. And they have the skills for that job. Or whether if they decide to continue their education in the next level, they're going to be successful there. Now, the monitoring activity, that will be the ongoing evaluation, which is separate evaluation. It's some combination, but the two level to use the assertion whether each of the component of the internal control, including the control to the effect of the principles, and present and function, that everything is in place, presented, and actually functioning. So that's your internal control. What we're chasing? Chasing through with having our operation. We have our reportings and we have our compliance. Compliance is related to the reporting, and the reporting is going to help us to our operation. What's the level? We're going to have the entity level, division level, operating units, and the functions. And inside we're going to have monitoring activities, or we can start with the control environment, the overall. On the top will be this is the, if you want, this will be the top of the iceberg. Then lower level will be the risk assessment. Next assessment lower will be control activities that we put in place. We have to communicate them, and we have to monitor the activity which has been communicated and has been established in order to reduce the risk, in order to improve the control environment. So the control principle 1 is the organization demonstrates a commitment to integrity and ethical values. That's the first. Second, the board of directors demonstrate independence from the management. That's an interesting thing because most of the board of directors are actually having the members which are part of the management of the company. So they're already biased. So principle 3 is the management establishes with the board overseeing, so the board of directors structure, reporting lines, and appropriate authorities and responsibility to pursue the objectives. Organization then demonstrate the commitment to attract, develop, and retain competent individuals in alignment of the objectives. So again, we're not changing the objectives because the individual is not in the capacity to meet those objectives. No, we're finding the person who meet those objectives, which will be appropriate under those objectives, to help us to develop the structure which is going to help us to establish that control environment in the company. Organization holds individual accountable for their internal control responsibility to get to pursue the objectives. And we're going with the next principle, next principle, next principle. And as you can see, those principles keep going and keep going and keep going. Why do we need those principles? We as an auditor, we need to understand those principles to assess the control environment in the company. If we have a good control environment, remember that's related to the control risk. If we have this company actually have control environment in place, which meets all the principles, that means our control risk will be low. Then we don't have to worry about the detection risk. And as you can see here, there's related first to the first level control environment. Second one is for the entity risk assessment process. Next one set is related to the control activities. Information communication. And the last level is related, should be for the monitoring, the control. So planning and audit strategy, again, we're going back to the formula for the audit risk model. Inherent risk times the control risk, which is the risk of material misstatement, time detection risk. So let's keep going with this one. Flow chart of the auditors considering internal control. So now we're focusing only on the control, internal control. First, develop understanding the internal control by evaluating the design of a control. So we're going to evaluate how the control was designed in the company. Second, we're going to determine how this design was actually implemented. As you remember from the managerial accounting, if the teacher mentioned this one, the successful company, why the company are successful? And what makes the difference between the basic company and successful company? So all the company have objectives. All the company have strategy. All the company have strength, weakness, opportunity, threats. All the company have plan how to achieve the objectives. But that doesn't differentiate good company and bad from not so good company, correct? Then what's the differentiation between the good company and successful company? How they implement the strategy, the plan, and how they actually execute it, how implementing everything that they already set up. So that's why you as auditor, first you have to check, is there good design of the control in the company exist? If that exists, then the next thing that you have to see is this actually implemented? And when it's implemented, is it actually constantly monitored? Having a perfect design, it doesn't mean anything. Implementation is the one that makes difference between good company and successful company. So now, how are we going to do this? We have to document the understanding of the internal control. So does the auditor intend to rely on the control? If we see that the design is in process, implementation in the process, the question is, can I rely on the control? If yes, then we're going to go to the reliance strategy. If we say no, we have to go to substantive strategy. What's the reliance strategy? Plan and perform the test of the control, set the control risk based on the test of control. Now the question is, does the chief, when we set up the control, those set of the control risk, is the achieved level of control risk supported? If the answer is yes, then we're going to go to document the level of control and perform substantive procedure based on the level of assessment control. If that's not in our system, then we have to revise planet level of substantive procedures. So we're going to put more procedures. We're going to document the level of control and perform the substantive procedure based on the level of assertion. Now, if we decide not to rely, now we're going to set up the control risk at the maximum. That means that's going to change the entire audit. We're going to document the level of control risk. Now the control risk is in a very high level. So that means we have to perform a very extensive substantive procedures in order to assess the control risk, which is going to hit us on the detection risk, obviously. The whole thing is here is to see where our detection risk has to be out of this formula. If now we're chasing here control risk, can I say the control risk is low? So once we pass this, if we go to the substantive strategy, after obtaining understanding internal control, auditor may choose to follow the substantive strategy, which is no internal control, is not in place, the level is very low, so the risk is too high. Then what we have to do is it's a high, set the control risk as high if some of the assessment first control do not pertain to the assertion. Control are assessed ineffective. Testing of the effectiveness of control is insufficient. Any of those can lead you to that conclusion that we cannot rely. If we go with the reliance, then we obtain the understanding of the internal control, and we have to plan to rely on the internal control and assess the control risk as a low level. If we decide to go to the reliance strategy, that's one of the options. So, what is the level of assertion that we chase? Occurrence, completeness, authorization, accuracy, cutoff, classification, presentation, which are related to transaction and events. Which are the control activity that we have to do? Those are the control activity. I strongly again suggest you is now start creating yourself Excel spreadsheet that will help you a lot. Get the assertion, definition of the assertion, what that means. And then start adding control activity which are related to that assertion level for these transaction events. You can easily get those one from the slides. So how are we going to understanding of the internal control? We're going to identify the type of the potential misstatements, pinpoint the factors that affect the risk of the management, and design the test control and substantive procedures. If we need to obtain the IT specialist, we're going to get that IT specialist. Remember, in the very beginning of the audit, there was an element that do we have enough expertise to do the audit? And do we need to hire external expert? We may need to IT specialists. Why do we need to evaluate the nature and the complexity of the entity system and determine whether the engagement team needs the IT specialist? So this is the level that we identify. Do we need this specialist or not? How complex is the IT system? And do we have somebody in our team that actually can understand it? If we don't, we have to hire that specialist. Understanding. So the next thing is to understand the control environment, entity risk process, information system and communication activities, and how those activities, actually those are separate because those activity has to be before the information system and communication. If you remember, the right order is environment, risk entity assessment process. Then they put in place those control activities. And after that, they come up, then they communicate and understand information system and how that's communicated. And then we're going to the fifth one, which is our, let's put it this way, and that will be understand the monitoring of the control. Let's assess your knowledge. How are we going to get that reasonable assurance? Any suggestions? Come on, say something. Are you guys there?
Yes. Yes.
Then go for it. Say something here. Whatever it is. Try to make an effort.
Maybe will be um,
What's the concept first? Let's talk about the first. What's the what
the
means?
reliable financial reporting.
Okay. But how we gonna reasonable assurance in terms of the internal control?
To reasonable that the internal control, when the internal control hubs are doing have the when the company implemented the internal control and the internal control have the four different system control like risks, like process. In this case, they can to consider the internal control is providing a good level of confidence. But if the company didn't have a very good system control, the this most difficult, the audit need to do more deepest.
So again, the concept of the reasonable assurance. What's the concept of the reasonable assurance? What's the reasonable assurance? Reasonable assurance is the level for which give us a comfort that audit exists. So what that means for the internal control? That means we have to make sure that the internal control actually exists in the company. How are we going to do that? By simply understanding the internal control. We have to understand the internal environment, understand the entity risk assessment process, understand what kind of activity they're doing based on the risk assessment, how those activities are communicated and implemented in the information system, and how everything is monitored. That will be the concept. And what's the inherent limitation of the internal control? Inherent limitation. Now, when you see something, the word inherent means anything related to the business environment, anything related to the company process, anything related to that area of the business itself. Well, limitation will be the how can I say, the entire business environment in the industry. It may be right now, if it's Canadian company, obviously will be affected by the tariff from US. So those are that will be our limitation of the internal control. Because imagine this now in environment when everything changes, especially with the tariff in US, that means that create incentive. Now we have to find out, is there any um, opportunity in place which company may explore to realize or to limit the effect of the that tariff. That's where we have to be. So let's go with the documenting and understanding of the internal control. First, we have to have those process manual organizational charts. We're going to see the flow chart of all the process, internal control questionnaires, and narrative description. That's very, as you can see, that's a very, very textbook kind of thing. How many companies gonna actually have all those process procedure manual organizational chart and the flow chart and internal control questionnaire and narrative description? Imagine the team that they have to carry in order to do all those kind of book documents, and something small like I just said with this tariff, you have to change your procedure manual right away. You have to internal console questionnaire has to be changed. Everything has to be changed. So basically, this is not like something static. This is more like an interactive thing. And those are the example of the documents. So have control environment questionnaire. First will be have appropriate entity policies regarding matters such as acceptable business practices, conflict of interest, codes of conduct has been established and they're adequately communicated. Yes. And what's the comment? The comment is what's the evidence for that? That will be the permanent working paper contain a copy of the Earthware conflict of interest policy. That's the company Earthware. Management demonstrate the appropriate what will be that? Let me change a little bit this. Appropriate tone at the top, including the explicit moral guidance about the right and wrong. Yes, the management maintain right moral and ethical standard and expect employee to act accordingly. As you can see, all this is like documental procedures which are put in place. So I'll strongly suggest you to copy this thing here on what you're seeing right now and save it somewhere, not for this course, not for the next course, not for CPA, but one day, if you become a controller and if you become the top manager of the company, which is going to happen eventually, trust me on that, I want you to keep this in mind. Because more and more companies right now, especially the one that they're facing, asking for, do you have a manual for guiding the appropriate behavior on the employee? Do you have a manual for the acting ethical? Do you have a manual for this? Do you have any manual for that? This chart's going to give you exactly what you have to have in place in order to justify that demonstrate the appropriate level or appropriate objective that the people looking for. So let's go with this one. The effect of the entity size and on the internal control. Obviously, the size is going to matter. Well, the basic components for the 5 components should be presented in all the entities. They're likely to be less formal as based on the size of the company. So once we see the size, now we're gonna, what will be the limitation? Management override the internal control, obviously. Human errors, a mistake, and collusion. Do you know what the collusion is? right from the start. Do you know what the collision is?
When different people are doing something incorrect, like they are.
Now the collision, the
Mhm.
first one, the first time then when you're facing the collision, that was in accounting, I believe 201. So principle of accounting, first part. That's we first talking about collision, or at least that's why I'm talking about collision. Collision basically is very unique. Two or three people working together to achieve something which is against the company. And that's a very interesting phenomenon. Anyway, so let's go with the assertion level control. How are we going to assessing the risk? Identify the specific controls, perform the test of the control, and conclude the achievement level of the control. That will be the first one. How are we going to performing those the test of controls? That will be the appropriate entity personnel. So we're going to ask for those. First, we're going to identify those ones. Then we're going to expect the documents with those people, observe the application of the control, and perform the application of the control by the auditor. Then basically we have to see, is this actually audit procedures exist? How are we going to document the control risk? Auditor will assess the control risks and basically to achieve those levels by documenting uses the structure working paper. Structure working paper will be the one that's provided by the caseware, the software that the auditor using. Internal control questionnaires and memorandums is another example for those. And this is the example of the assessing the control risk and what's the effect. So basically inventory, the inventory balance, as you can see, is ginormous. Account characteristics, which is the characteristics of the related to the inventory, which is the extent of the understanding needed of the plan of the audit, which is the control risk assessment, and how we're going to plan, what kind of procedures we're going to put in place in order to reduce the risk that we already assess. So again, one thing that I want you to understand, we adding the procedures only and only to reduce the risk. Which risk? The one that we assessed. Based on what? Based on the understanding of what we need for our audit. Why do we need to do? To achieve the objective of the audit, to show that the financial statements are actually accurate. That's if you have to go backwards. Let's do this knowledge. Which of the following audit techniques most likely will be prepared the auditor with the least assurance about the effectiveness of the operation of the control? We're chasing the least assurance, the lower level of assurance.
Inquiry.
Inquiry.
Inquiry of entity.
So when we do the walkthrough, basically our level of assurance is high, right? When we do the observation of the entity person, when we observe the entity personnel, our assurance is high. When we reperformance, when we check the reperformance of the control, we checking the reperformance of the control, audit assurance is high. When we just make an inquiry of the entity personnel, that will be the last thing. It's still gonna be assurance, but that will be the listing. So let's see this one, performing substantive procedures. Why do we need to perform the substantive procedure? Because low detection risk strategy is choose. So the nature is audit test of the all significant audit assertion using the following type of audit procedures: physical examination, review external documents, confirmation, or reperformance. Next one is that's for the entity one. For the entity two is the high detection risk strategy. Then we have to collaborate audit testing, physical examination, analytical procedures, substantive tests on the transaction imbalances. And those will be the timing, and that will be the extent. What will be the extent here on the substantive procedures? Timing. We're going to have interim and year-end. Interim means during the year. All tasks completed at the year-end. In this interim, when we have the high detection risk, we're gonna have this interim first timing, and then we're gonna have at the year-end. So the interim timing is beginning of the year. Then we're gonna stand the entity and environment of the planning of the audit. Then we're gonna do some interim test of the control during the year, right? We already have the client. We're not getting the client here. We already get the client. Let's say most likely that will be a repetitive client or the one who continue with us. At the beginning of the year, there's nothing. Then we're gonna focus on the assessing the risk. Then we're gonna get some understanding of the entity environment, and we're gonna start planning for the audit. We're gonna do some interim test of the control in the internal control of the company to see, can we rely on this control? And if we don't rely, then we have to start conducting some substantive testing, again with the control. So, and that will be, as you can see, the financial statements are due on December 31st. By February 15th, we have to issue the audit report. So that's why we're starting our substantive testing, usually at the year end. And we're doing a little bit more extensive stuff. So the internal test of the control with the assertion begin testing the assertion being that's not significant test of the assertion, but we're chasing the control and efficient use of the staff time. So basically we have to be very efficient on the staff. We're not wasting too much time here. We're not setting like a ginormous hours to do that. On the interim, that's for the test of the control. The interim substantive procedures, those are different. That will be what will be the procedures we can do to test the internal control. We're going to test the control environment, availability of the information, the purpose of the procedures, risk of the material misstatement, nature, and ability of the auditor to perform those test controls. What will be the accounting application which have to process during the service organization? If we have the organization doing service, in some entity may have some or all accounting transaction process by the outside service organization. So if the third party doing the bookkeeping, then since the entity transaction is subject to the control of the service organization, one of the auditor concern is that internal control system in place at the service organization. So now we have to check the bookkeeper, what kind of system they're running and what's the control in that system. It is not uncommon for the service organization to have the auditor issue one of two type of report on their operations. So we have to test that company. First type of the report is describe the service organization controls and assess whether they're substantially designed to achieve the specific internal control objectives. And second is to goes further by providing assurance on the operating effectiveness of the service organization control based on the auditor test of the control. So those are the two types of the reports. But again, those are related to the when the company using the service company to process all the information. In this case, auditor may reduce the control risk below high only if the basis on the services, if we do the second type of the report. In any other instances, the internal control should be set up as a control risk should be set up as a high. Now, how are we going to communicate? How are we going to test the communication with the internal control? We're going to check for the control deficiency, significant deficiency, and material weaknesses. And those are the definition how those one exist. That will be the example of reportable conditions on the deficiency and what's the failure to the operation internal control. And on the IT environment, we're going to do some general control and some application control. General control will be the data center network operation, how they operate, system software acquisition, changes, maintenance, how the system software is done, access, and application system acquisition. And then we're going to check the application control will be the how is the control over the data captures, data validation, process, output, and errors. And those are the common data validation controls that can be in place for any of those controls that are in place. Again, everything is on the internal control. So flow chart symbols, those will be the symbols that they're using in audit. I honestly never see those symbols, if I have to be honest with you. This is the first time I'm seeing those symbols. But I'm assuming they're using it in audit. If this is some kind of secret language, I guess, between the auditors, so they know what they're doing. That was your chapter. So let's keep going with this internal control. And let's see what will be the internal control over the financial reporting. This one's the internal control over the company. In the financial statement audit. So now let's see what will be the internal control in the financial over the financial reporting. Those two chapters are kind of related. That's why I'm combining those together. And there will be only one assignment for chapter 6 and chapter 7 altogether. Let me see which chapter, which screen you're seeing. You see the chapter 7, right?
Yes,
Yes.
but we don't have the slides
For chapter
in.
7?
Yeah, we have 4, 5, and 7. I and 6, sorry,
5
but
and
not
6?
7.
Not
Yeah.
7? Just give me a second. Just one
Okay.
second.
Thank you.
No problem. I have to update all the slides, so we're getting deeper. So I have to update. So chapter 7, because I was thinking to give you chapter 7 part of the next part, but I saw okay, so it doesn't. Chapter 5. Oh, you have up to chapter 5.
No,
Chapter
until chapter 6, I have.
1, 2. Oh yeah. Let's edit this. Let's give you more. Uh, Let me give you more. Chapter 6. Chapter 7 you don't have, right?
Right.
Try it now and tell me if you can see them.
Yeah, it's showing now.
Awesome. Let's see what this auditor is doing on the internal auditing, the internal control, or the financial reporting. Again, the management responsibility require the management of the public traded companies to issue the report that certifies the effectiveness of the internal control. So what the auditor is doing, auditor assuring the other people that this internal control is actually in place, but they're not the one who is responsible for anything for the internal control. It's management responsibility. So in United States, they have this management is required to comply with the following requirements. That will be from where this abbreviation came from. Now I have ICFR, but I'm looking for where that abbreviation came from. It hasn't been shown anywhere. So what's that? Will be internal control financial report. That will be the internal control over the financial reporting. So internal control over financial reporting, that will be under United States. Internal control over financial reporting defined that is process designed to provide a reasonable assurance regarding the reliability of financial reporting and the preparation of financial statements. So now we're focusing only on the financial reporting and the preparation of financial statements. So how they maintain the records? Reasonable assurance of the transaction that are properly authorized and recorded, and provide reasonable assurance regarding the prevention, timely detection of unauthorized acquisition or disposition of the company assets. So internal control over deficiency. Deficiency defined. The control deficiency exists when design or operation of the control does not allow management or employee in the normal course of performing their duty to prevent or detect misstatement on the timely basis. That's where the control deficiency exists, and significant deficiency is the control is a control deficiency or combination of the internal control over the financial reporting that is less severe than material weakness, but yet important enough to merit attention. Those are the significant control. What's the control deficiency and what means the significant deficiency here? So the control deviation caused by the employee performing and control procedures that he or she is not authorized to perform, that will be considered deficiency in operations rather than deficiency in design, significant deficiency or material weakness. So you can see how now we're going to the level of the deficiencies. A relationship in the magnificence, the materiality of the control deficiency. If the deficiency will be material, if it's related to material weakness, and that will report externally to audit committee on the management. If it's not material but significant, that will be reported to the audit committee and to the management. But if it's not material, not significant, that's going to be reported only to the management. This is what based on the deficiency. Again, the deficiency, we have the significant deficiencies. And the other one is the material weakness. That's defined in combination deficiency, such as reasonable possibility or material misstatement of the annual or interim financial statements. which are not going to be prevented or detected on the timely basis. So, management assessment process, what the management can do for those internal control procedures over the financial reports, identify the financial report risks, consider the location, and evaluate the evidence about the effectiveness of that internal control over the financial reports. The whole objective is to have the reliable financial reports. That can be achieved by efficiency and effectiveness of the operations, by complying the law and the regulations. So we're going to have over those examples of the entity control and different control over the system, over the override and bypass, assessment process, monitor the result of operation, control over the period and financial reporting process, anything related to the financial reports here. What will be the documentation that the management has to keep? They have to develop sufficient documentation to support the assessment and effectiveness of the internal control, and that may include the paper, electronic files, policy manuals, process models, flow charts, job description, documents, or other forms. How are we going to integrate this to the audit? The integrated audit is composed of the audit of internal control and the financial statements. So once we establish the internal control exists, then we're going to see control, how is the control over the financial statements. And the control testing impact the planned substantive procedures. So basically, if the control level is assessed to be low, that means risk is high, then we have to increase the substantive procedures. So we're going to test the internal control, and then we're going to establish the substantive audit procedures. Again, if the internal control level is low, that means risk is high. We have to increase the substantive procedures in order to reduce the audit risk. If the internal control is high, that means the risk is low. That means our substantive procedures will be less. So plan the audit, identify the control test, evaluate the design, the test of the operating, and identify the control deficiencies. So let's start first with the planned audit. We're going to plan it similar to the process of the audit of the financial statements. Consider the following: role of the risk assessment, scaling of the audit, and using the work of the others. If we use the work of the others, we have to evaluate the nature of the control subjects, evaluate the completeness and the objectivity of the individuals who actually did the work, and test of the some work performed by the others. So always remember this: who did it, what's his involvement in the whole process, what's his objectivity, is he biased or not, is he affected by the information that he is testing or he putting in the control. And then once we establish all those ones, we have to test ourselves how this actually works. And that's the risk associated with the account. If we test it increase, that means we have to increase our procedures. That means more work for the auditor. How the controls, how to test the controls? First, we have to identify the entity level controls. Then we're going to identify significant accounting and disclosures and relevant level of assertions. We have to understand sources of the misstatement, and then we have to select how we're going to test that control procedures, which we're thinking have misstatement or we cannot we cannot rely on. So we're going to identify the significant accounts. Now that's why we need the materiality. So now everything's going to start making sense. First we identify the materiality, overall materiality. Then we're going to go in with the second materiality, which will be the test materiality or the performance materiality. And then we're going to identify the significant amounts which fall into our size or our sample. So we're going to to identify significant account in disclosure. Auditor says the following risk factors. First, we're going to assess the size and the composition of the account, suspectability of the misstatement, volume of activity, nature of the account or disclosure, and the counting and reporting complexities which is related to that account. Exposure to the losses in the account, possible significant contingent liability, existence of related party transactions, and changes of form of the prior period in accounting disclosure. Now, looks very heavy. Again, all those questions you're asking yourself in the time of 5 to 10 seconds once you look at the account. How possibly you can do this with the practice. That's why that's why we need you need understanding of the financial reports and everything. So basically an understanding of the business. That's why you're doing understanding of the business, understanding of the transactions, understanding of the events, like the understanding of the internal control in place. And then we're going to identify significant accounts by putting this knowledge in place. And you personally, you should know by now which accounts are more exposed to some kind of deficiency, and how we're going to test those accounts. So basically, if you see the accounts which dealing with the miscellaneous expenses, obviously there's a lot of things that you have to chase there. If you see account prepaid expenses, there's less thing that you have to look there. What you have to do is ask for the people who's running that account, give me justification of the final balance as prepaid expenses, from where that balance come from. And if they can give you that one chart with how the prepaid expenses was created in the beginning, how was transferred during the period, how long they are allocated, for which period, how much is allocated, and if they can justify the funding balance, you have everything in place. So you can see for some accounts you're going to have a little bit more work that you have to do, or more risk that you have to deal with. Some accounts, not that much risk. But in order to assess those risks, you have to go to having all those ideas in mind: size, suspectability of the misstatement, volume of activity, nature of the account, reporting complexities, exposure to the losses, possible significance of contingent liabilities that will be related to the warranty expenses or for allowance for doubtful account, existence of the related party transactions. Is this sales actually effectively was made, and if the client actually has the rights for the warranty. And changes to the previous period, obviously you're going to see the differences between 1 year to another year. Which is the source of the misstatement? How are we going to understand the likely sources of potential misstatement? You have to understand how the flow of the transaction. So you literally need to know here debit and credit. And sometimes I'm kind of pleasantly surprised that auditors that coming to the organization, they don't understand debit and credit. Sadly, but that's the reality. Anyway, we have to identify the point within the entity process and on which the misstatement could arise. So what is the point if there's an account and the related transaction to that account, at which point, which is the weakest point of the whole process? Imagine this. First, in order something to become an entry, you have to have document. That document has to be approved by somebody, which then somebody else has to do the simple entry, debit and credit. Now that debit and credit has to fall in the right accounts based on the document which has been approved. Then before that entry is posted, somebody has to approve that entry that actually says, yes, that actually going to the right accounts. Once they go to the right accounts, we have to make sure that the system automatically posted to those accounts, which accounts then become a part of the one bigger account, which bigger account is represented in the financial statements, which somebody follow all of this process. And the financial statements are prepared by the financial standards and everything is in place. So through the whole process, all the flow of the transactions, we have to identify on which point they may be potential of the misstatement. Then we have to find the control that management has implemented to address those potential misstatements. If the misstatement comes on the first place where the document comes in the company, now we have to find out is the management have to put in place any procedures which reduce that risk. So basically, if the management puts procedures that if the document is not stamped and signed by the controller, it cannot be processed further. If the transaction is not printed before it's posted and signed on authorized and signed by somebody, cannot be processed further, then we have the control procedures. Identify the control that management has implemented over the prevention, the timely detection, and of the unauthorized acquisition used for disposition of the company assets. So now we're chasing the assets. When every time when the purchase is purchased or purchase is disposed from the company, there has to be authorization from the management. And that's will be the how we're gonna select the control to test. Point of the fraud, nature of the control implementation, and the risk that we're chasing, whether there has been the changes in the volume of the nature, whether there has been changes in the design of the controls, degree, whether there has been changes in the key personnel, control relies on the performance of the individual or is automated. So basically, who's doing the control? Is it the individual who actually see it and sign it, or is just automated procedures, which is done, I don't know how it's done, but something like that. So once we evaluate, so now we have to evaluate, design, and test operating effectiveness of the control. So basically, we're going to evaluate the design of the control. How effective is that design? Test, is this actually effective? And then we're going to collect the evidence for that. Now, suppose that the entity implement the control, whether its sales managers review and investigate a report listing sales invoices with unusual high-low gross margins. Would inquiry of those sales of the sales manager as whether he or she investigate discrepancy be sufficient evidence to ensure that control is worked effectively? What do you think? It's open answers, so don't worry about it. You may say no, you may say yes. Either you say it's not, there's no right and wrong here. Let's put it this way. Are you guys there? Give me something. Anything. Hello?
For this,
Yeah.
it's not further inquiry is
Inquiry?
not sufficient evidence.
Okay. So it's not going to be sufficient. We still have to do some more stuff. We cannot rely completely on what they're doing.
I believe so, because it seems like sales manager is in charge of those things, and if the person doesn't recognize that issue until it came to the audit, then probably we need to do something else other than that person.
Okay. Okay, that's a good answer. Any other suggestions? Where's Christina when we need her?
I'm here, but my brain has stopped working.
You
Too much information.
Too much information. I know it's coming from
Yeah,
everywhere. The information now start coming from everywhere. But
yeah.
again, the thing here is, if you see this, if you see that entity can implement the control where the sales manager review and investigate report listing sales invoices with an usually high or low gross margin, would inquire the sales manager as to whether he or she investigate discrepancy be sufficient evidence. So now it's like the person who's selling the cucumbers is the one who chasing the report of the cucumbers. Are they sold appropriate to the right person and the right thing? Is he affected by this report? Most likely. Is he seeing his benefits to see which one is the high and low? Yes, it is. Can we rely on his judgment on this one? Probably not. Is he independent in the situation?
No,
Definitely no. Is this will be the sufficient evidence?
No.
No,
no.
right? Should corroborate this responsibility to perform other procedures such as inspecting the report generated by the performance of the control and evaluating whether the appropriate action has been taken. Why? Because the salesperson is the one who's directly involved in those transactions. So yes, it's a good starting point, but we need more information here. So how are we going to evaluate identify the control deficiencies? So now the identification of the likelihood and the magnitude. We're chasing how likely is to have the deficiency and what is the magnitude of those deficiencies. So if the deficiencies or combination prevents the auditor from having the reasonable assurance, then the auditor should treat the deficiency as an indicator of the material weakness. On which of the material weakness? That will be the material weakness here. How can we reduce those material weakness? If the material weakness corrected before the date, there must be sufficient time for both management and auditor to test the operating efficiency. So basically, what we're trying to do is we found a deficiency, we communicated that with the manager, with the management. Management put in place changes which would eliminate that deficiency. Now, do we have enough time to test it, what they did, before we issue the report or not? If we have enough time to test it, then it's not material weakness anymore. We don't have to worry about it. We can issue the original report. So if the auditor should document the process, procedures, judgment, and the results which are related to the internal control on the quality of the documenting standards, and the use of the service organization, if the company using the service organization Remember those reports, the two reports that the auditor can issue. The first report is not enough evidence to lower the control risk. The second report is the one that lower the control risk. In the first one, if we get only the first one, we assessing the control risk as a very high. To obtain we have to understand the nature of the and significance of service providers and design to perform the audit procedures to respond to risk that we may get from the identification of the and understanding of the business. So we as auditors still have to assess that third-party organization. Assets is the one that we're chasing. Remember, in the company, capital, when the people investing the capital, they investing with the capital, they purchasing the assets, which assets later are sold and generating revenue. So where is the capital? Now it's the assets. So what we have to do, we have to find out where the assets is. Is there reasonable? Is there any safeguarding procedures in place? So any policy and procedures which provide a reasonable assurance regarding of the prevention or timely detection of any authorized acquisition or disposal of the assets. So somebody decide to purchase, let's say, a laptop, which somebody using the laptop for his personal purposes, not for the company. So now what we have to chase, is this acquisition been approved by somebody? Is it reasonable? Is there anything in place that shows that there's a policy process which regarding to the purchase of the assets in place? So if we have the computer assisted audit techniques, that will be the computer assisted audit techniques, including the general audit software, customer audit software, and data test. So for those general software, we're going to have the function will be to file the database access, select the operations, arithmetic function, statistical analysis, report generation. So that will be the description of any of those functions that this audit software is going to do. That's why this course is passing the the data analytics as well. Why? Because through the software, we're using the data analytics procedures to identify analysis, to do the statistical analysis, arithmetical functions, select the operations that we can chase and following further. So what will be the custom audit software? Custom software is generally written by the auditors for specific audit tasks. That will be the expensive, obviously, to develop, may require a long development time. So the question is the auditor has the expertise to develop that software? How long is going to take it? Because on the audit, we don't have years to provide us the audit, and how well we know the entity. We're going to test the data. Test the data development of the developed by the auditor to test the application control of the entity computer programs. So we're testing the clients' softwares and computer programs. We have the data evaluation, the control, process logic control, arithmetic calculation, and inclusion into transactions. And this is the management responsibilities for the internal control of financial reporting. What else? I believe that's pretty much the everything. So which are the reports? The final stage is the reports. The reports that the auditor can issue, we talk about in the chapter 1, if you remember, but that was long time ago. So unqualified opinion, which means that there are no material weakness. Qualified is not here, but disclaimer in the adverse opinion is those are the most serious. If there's a limitation of the scope, scope limitation, then we issue the disclaim of the opinion, and adverse opinions is required if the material weakness is identified. So those are the types. If the control deficiency, if we have the control deficiency and all those significant deficiencies, but those are addressed by the management, we can issue the unqualified opinion. If we have the material weaknesses, we issue the adverse opinion. If the scope of limitation have a very, very small effect, unqualified. If we have more than minor effect, then will be disclaimer of opinion, or we can completely withdraw from the audit. Now, obviously the management is responsible for the incomplete or improper presented information. Auditor decides to refer to the report of other auditors if there's any available. And if there's any additional information which are contained in the management report on internal control, we have to assess those one. And there's some, if the weaknesses are addressed by the management within the period of the audit, then everything that's gonna give us an unqualified opinion on the audit. So, which are the audit required communication in the audit? We're gonna deal with the significant deficiency, which have the material weakness, and we have control deficiency, and that will be the end of this chapter. Now, I understand it's getting heavier.